just get started. Today, I want to share with you some real-world trade management techniques that you may be aware of, but you might not be aware of and might not be using in your account. What we're going to share today can help you right now. It's going to be actionable ideas that you can use as your account, as well as ideas that will help you potentially further down the road as well. Before we begin or go any further, I just want to ask real quick, what do you personally feel is the biggest roadblock to potentially your investing success? Now, many of you may be successful traders. You may be seeing gains over the past 2 years, 3 years even. Maybe the last year wiped out some of the losses. So what I want to know is that what do you feel is going to help you be more successful if you're already successful, or if you feel you're not reaching your goals, what do you feel is the biggest roadblock? Do you feel that you do not have enough knowledge on stocks, options, trends, and so forth? Do you pick more winning trades than losing trades for the strategy you're using and the sentiment, but the losses you're taking are outpacing the gains? Have you picked more losers than winners, whatever strategy you're currently using? Do you feel that you've mismanaged trades? Market timing, for example. Maybe you rolled or adjusted a position too soon or in too much of a panic after a move on the stock. Or do you just feel you don't have the time to keep up with the market as well? Okay, so we're going to leave this poll open for about another 30 seconds. If you haven't answered yet, I encourage you to do so. Kent says, why am I muted? Ken, everyone is muted. Okay, during this presentation, we're just going to present material to you. We don't want to have everyone unmuted in the background. Of course, if everyone was unmuted in the background, if any dogs were barking, phones were ringing, it would just take away from the entire presentation. Okay, so that's why everyone is currently muted during the presentation. All right, so let's go ahead and close that poll, and I want to share the results with everyone. 8% of you feel that you don't have enough knowledge about the stocks or the options right now. No one said that they picked more winners, but the losers are outpacing the gains. Well, 17% of you have picked more losers than winners and are falling behind with the strategy that you're using. 50% of you feel that you've mismanaged trades. Market timing is an issue. And 25% of you also feel that you just don't have the time to manage the positions. Okay, well, let's go ahead and hide that there. We're going to try to solve the problem for everyone. Now, let's be honest. In the market, we love winning trades. We hate losing trades. We want to see more winners, and if we do realize we're going to have losses from time to time, we want to start losing less on those trades and have less losing positions. One of the biggest things I hate in the market is picking 2 or 3 stocks in, let's say, a 1 or 2 week period that have the same similar technical and fundamental indicators, and to watch how 2 of those stocks go up as I expect, but one of them drops more than I originally expected, completely going opposite of the other 2 trades that had the same kind of indicators on it, but that loss outpaces the 2 wins that I had. And then I also hate having to take a loss, 12%, 15%, if I'm using leverage even, maybe a 30 or 40% loss on a long call, and then having to manage that loser for months, either tying up capital or entering into doubt and mismanaging the positions. Well, one of the things I really hate the most, and I feel that you probably have the same sentiment, is we picked the right stock, we picked the right trade, it moved up for us, we had a gain, but then we didn't act on it correctly. We didn't act on it quick enough. We didn't lock in the gains. We didn't lower our cost basis by maybe generating income or doing a different adjustment, and then the stock moved against us afterwards, and what we had as a gain now turns out to be a loss. That's what I really hate more than anything. So, well, what do we face with a loss? Well, obviously, in addition to the reduction of capital, which we don't want to see, we also face that unfortunate prospect of long-term management, hoping for a recovery. An uncertain path forward. Everything that we selected on this position pointed to a gain in our direction, the sentiment that we wanted, but it moved against us, which again can lead to the mismanagement, managing a position out of frustration, knee-jerk reactions, maybe putting ourselves in a worse position than when we started. And of course, can also affect our confidence. And everything that we were told, everything that we were shown to do, we followed the rules, we did this, and yet we still have a loss that maybe outpaced the gains that we were taking. You talk to any covered calls trader, they might make 2 or 3% on their winning trades, and they might be right 70 to 80% of the time. But those 2 or 3 losses might be down 10, 12, 15%. So even being right 80% of the time, they're actually losing money. Those of you that are maybe trading vertical spreads, credit spreads or debit spreads, you know that one loss can wipe out 10 previous gains if you're looking for those higher probabilities. So even though you selected everything right, you have the proper structure from what you were taught, you're still falling behind on the position. That can really affect the confidence. And what do we face when we have a gain? Well, it's the initial joy, a sense of success, but is that gain going to continue going forward? We don't really have a clear path for us. We have a chance to miss out on more gains. That annoying thought with, hey, I'm up 10%. Should I close now? I've hit my goals. That's great. But what if the stock goes up another 5%, another 7%? Maybe you miss out on those and the new position you got into didn't perform as well as you wanted to. We suffer that unfortunate possibility of having a gain and thinking that we're good, not taking a management, and watching that become a loss. And of course, the potential for further tails down the road of that one that got away. Now, what do I mean by that? When we have a gain, we're typically going to look to approach the position in one of 4 or 5 ways. Okay? What are we typically taught? If we have a gain in the stock, you've been just trading stock, maybe you've even been trading covered calls, or maybe you're doing long calls. But what are we going to do when we see a position that has, let's say, a 10% gain in it? Are you going to close out now and take the gain because you've matched your goals? Maybe you're going to consider closing half of the position, reduce the cost basis, still leave some of the upside open. If we have a stock that's gained or maybe a long call, you might sell a call against it, generate $1 or $2 worth of income to lower your cost basis, still maybe get assigned at a higher price than your purchase price. You would create a covered call if you just own stock, or maybe a calendar spread if you had a long call. One of the most popular ones, of course, is to say to myself, well, the stock's moved up 5 or 10% from where I bought it. Let me use a trailing stop. Okay, stock's moved up 10%. I'm going to set a trailing stop $1 below that price. So if the stock falls, I'll still make maybe 8% or 9% return. Get out of the position, but I didn't risk it falling back further. Or we might just do nothing and say, hey, the market's still strong. My decision process and stock selection is strong. I'm going to leave this one open. Okay? Those are some of the common ideas. You might have other ideas, but let me ask you this. Looking at your positions, if you would purchase an underlying stock, maybe something you read about in the news, something that was recommended to you by a service, and you saw, let's say, a 6 to 10% gain in the underlying security, what would you do to manage that unrealized gain? Would you close out the stock entirely if you'd hit your goals? Look for other positions? Would you close part of the trade and leave another part open for potentially further upside, but try to reduce your cost basis? Would you create a covered call now, generate some good income at a higher strike than your purchase price to lower your cost basis? Or would you simply just say, you know, I've got this gain, let me set a trailing stop. If it falls, I'll still make most of what I expected on the position and maybe give up some upside? Or do we sit back and say, I'm confident enough in my stock selection and in the market that I'm going to do nothing with this gain. I'm going to leave the position there and see what happens next. All right, folks, so I've had the poll open for almost a minute. I'm going to leave it open for another 10 or 15 seconds. If you haven't answered yet, of course, I encourage you to do so. All right, well, let's go ahead and close that poll now. And of course, we'll share the results with everyone. Those of you that answered the poll, 21% of you are going to close out early, look for other positions. 14% of those in attendance today are going to close part of the trade, maybe leave the rest open. 36% of you, looks like the highest today, you're going to sell a call to generate income. 14% of you are going to set a stop or a trailing stop. And then 14% of you as well who answered the poll, you're likely to do nothing, trust in your stock selection, and allow further upside. All right, well, let's take a look at all of our ideas in action. What do we want with a win? The simple answer, we want more. When you have an unrealized gain, typically we want to make sure we lock in that gain and don't give up the returns. We want to take advantage of some way to reduce the cost basis. We were right, might as well use that to our advantage, lower that cost basis down and still maybe get further upside, and leave it open if we're still expecting further gains as well. Okay? That's what we want when we have a win. Now, let's take an example. January 23rd, Fusion subscribers at radioactivetrading.com saw us buy into AEIS, Advanced Energy Industries. And at the time, the stock was trading at $56.80 per share. Within 20 or so days, AEIS was up to $62.50. We have an unrealized gain of $5.70, or just above 10% in under a month. Okay, so here's where we got. We have the trade entry here. Our cost basis right about $56.80 on January 23rd. And the stock moves up to $62.53 February 15th, just really about 23, 22 days later. Okay, so we've got that unrealized 10% gain on our position and, of course, an uncertain future going ahead. Now we have our choices. We can close now and take the gain. 21% of you would have likely done that. You would have realized 10% gain on your position. Now you might go look at others as well. We could have closed half. Let's say we had 100 shares of AEIS with a cost basis of $56.80. We could have sold 50 shares at $62.50. This would have taken in $3,125. And remember, originally we would have paid $5,680. So now, with that cost in, income reduction, we'd now be holding 50 shares at $51.10. You sell a call to generate income? Well, the stock had moved up to $62.50. To generate a high amount of income and still get assigned potentially higher than your cost basis, on February 15th, we could have sold the March 17th 60 call for $360. This would have been a potential return if assigned of 12.8% at March expiration, for a monetary value of $680. We'll set a trailing stop. Remember, our stock had moved up to $62.50. I want to lock in most of that 10% gain. We could have set a stop or a trailing stop at $61.50. And it's still a gain of about 80%, 83% of what we would have had. So we'd make 8.3% instead of 10% on the position, but we still leave the upside open, and we've got a position that will still maybe generate close to our goals for a 20 or 30 day, going forward to March, maybe a 45 to 50 day trade of 8.3%. And of course, do nothing, and we hope and pray. So these are the actions you could have taken on February 15th. And going forward to March expiration, March 17th, that's where we sold our call, so let's look at our comparisons of what would happen next. Over the course of the next month, the stock continues its move. We see AEIS go from $62.50 up another 5 points, 6 points really, up another 10% to $68.62 on March 17th. Now, notice here, on February 17th, what we have highlighted here on February 17th, the stock dropped down to $60.84 during the trading day, which means the stop would have been hit, we would have been closed out of the position. The next day, maybe we buy it back in at about 62 or 64, going forward, 63 there 2 days later on February 21st, but we would have been stopped out of this position. Closed it out at 61.50. Remember our trailing stop when that was hit. And we still would have made 8.3%. All right. So here we go. We're up a total of 9.8% from the position, from the first gain. The total, we're up 1182. Bought in at 56.80. Stock's now trading at 68.62. So we have an unrealized 20.8% gain from that original purchase price. What are our comparisons again? All right. So remember, if we would have closed on February 15th, you're sitting on a 10% gain. You had nothing else to risk over the next 30 days. You took your 10% and you moved on. If we had closed half and left the other half open, remember, we would have reduced our cost basis and had 50 shares of stock at 51.10. Well, now we could sell 50 shares of stock at 68.62. We've taken another 3,431, so our gain total on the position would be 876, or 15.4%. Now, if you chose to sell a call, you might have taken that 60 call for the premium of 360. Here you are getting assigned at $60 per share without management for gain of 12.8%. And if, of course, the 14% who would have set a stop after that initial gain on the position on February 15th, you would have been stopped out at 61.50. On February 17th, 2 days after you set the stop, so you'd still have a gain of 470 or 8.3%. Maybe you could have bought back in a couple days later at 63 and gotten another $400 or $500 profit as well, but that would have depended on your outlook on the stock. You likely would have taken the 8.3% gain and moved on. Now, for those of you who do nothing and hope and pray, well, your hopes came to fruition. You now have the largest gain, unrealized. But on March 17th, you could sell to close the stock, 68.62. Unrealized gain, or at this point then it would be a gain of 1182 or 20.8%. But of course, what happens at that time frame? Now you guessed right. And the stock moved up again. You did nothing. You didn't protect yourself. Didn't generate any income. You didn't cap your gains. So now you're at a 20.8% return. What do I mean by start the cycle over? Well, now what do? Do you close it out and take the gain? Do you close half of it at the 20.8% gain? Do you maybe sell a 70 strike call now for April to generate some income? Or do you set a trailing stop now at maybe 67 to get out of the position? Or do you do nothing again and look forward? So that's what we face when we have a gain. In this case, it turned out to be right on the AEIS with holding on and doing nothing. No management. Got a little lucky there. But now what do? That's sometimes the dilemma of having a gain in the stock. When do we take the action? When do we don't? Okay. So the simple math. The position returns. If we would have closed on February 15th, you had a gain of 570 or 10%. If you would have closed half, left half open, March 17th, we have a gain of 876, 15.4%. For those of you who sold a call, you lowered your cost basis on the position by 360. You get taken out at $60, not using any management there, buying the call back for about $8, $9. So we have a gain of 680 or 12.8%. Your trailing stop would have been closed out 2 days later on February 17th, but a gain of 8.3%. And those of you who did nothing, of course, you're looking at a 20.8%. But what are our goals when we have a gain? What do we want to do to maximize value, keep the winners, and still look for potential return? Well, we want to lock in some of those gains. We don't want to give up returns. We want to take advantage of picking the right stock and be able to reduce the cost basis by generating income against it. We should reward ourselves by doing that. But we also want to leave the upside open for higher potential gains. Now, which of our 5 solutions that we reviewed really solves this? If you took the gain on the stock and closed on February 15th, you locked in a 10% profit. You didn't take advantage of picking the right stock and generating income against it to lower your cost basis. And of course, you're out of the position with that 10% gain, so you didn't leave the upside open. Well, selling half and leaving half. Did you lock in the profits? You took some money off the table, drastically reduced your cost basis down to 51.10. So unless the stock dropped below 50, we could easily say that we locked in profits. Did you generate income? Well, I left this as sort of an open box here. You reduced your cost basis by selling half of your shares. You did sort of generate income, but you didn't keep the full share block and lower the cost basis against the full shares you originally purchased. So I'm going to say you generated income, but you had to reduce your holding for less profits in order to technically generate income by selling half. And did you leave the upside open? Why, yes, you did. You had half your original shares or part of your original contract holdings on the position, and you were able to still take advantage of further gains to the upside as AEIS continued to move up as well. All right, selling a call. I showed selling that March 60 strike call for 360. If you had originally purchased AEIS at 56.80, waited for the stock to move up and sold that call, you would have reduced your cost basis down to about 53.20 with that 360 premium you generated. But although you lowered the cost basis and sort of increased what we call the downside protection in a covered call position, you didn't lock in the profits. If the stock fell to 50, you'd still have a loss of 360 on the position. Did you generate income? Absolutely. You took advantage of the gain, picking the right stock, used the options to your advantage to lower your cost basis. But what happens with a covered call? Well, we entered a contract that obligates us to deliver shares of stock at $60. It went up to 68. We don't see any more profit above what that 12.8% was on the position. So in that case, we didn't leave the upside open for further profit. Would you have been content with a 12.8% return from January 23rd to March 17th? I bet you would. You're probably averaging about 6.3% return per month, which is a great annualized return. Okay, but you didn't leave the upside open for those further gains up to $68 per share. And your stop order and the trailing stop. Did you lock in profits? Well, I'm putting this as a question mark. In the case of AEIS, we can say that you did lock in profit. You set your stop at 61.50. It was triggered 2 days later during the trading day. The stock did hit a low of 60.84, but since it hit the stop during the trading day, you probably got out at around 61.50 and got an 8.3% return. But if something happened over the weekend, one of the weekends, maybe it didn't hit 61.50 and we kept going into February. Let's say one weekend in March, the stock had just dropped 10% or 15% from where it was trading. If it violated that 61.50, well, you might have gotten out at 58 and only had a small gain on the position, because remember, the stop would be violated if that drop happens in the pre or after market hours. So you would still take a loss on the position potentially. Did you generate income? No. You didn't take advantage of generating any income, but you did leave the upside open to get the further gains if that stop order had not been triggered originally 2 days after we had placed it. All right. Now the do nothing, hope and pray. Did you lock in profits? No. Did we generate income taking advantage of picking the right stock? No. Did you leave the upside open? Absolutely you did. But did you do anything to control the downside or control the risk? No. The downside is still open. Your risk is still essentially what you invested in the position. We had an unrealized gain. So the closest one we have to really all three of these, satisfying all three of our goals when we have a gain, would maybe be to sell half and leave half open. But again, in order to do that, we had to give up some of the holdings that we had. And at the same time, we did reduce our cost basis by selling half of it, but did we really generate any income directly? No, we had to give up half of our holding or part of our holding in order to generate income. So, can we have it all? Well, of course. There is a way that we can satisfy all three goals. And the first trick, what do we want to do when we have a gain? We want to lock in the gains. Rather than focus on selling a call first, let's lock in the gains. And how can we lock in the gains? Well, instead of selling a premium, let's take a little bit of the unrealized gain we have in the position and buy something that guarantees an exit, unlike our stop order or our trailing stop. So on February 15th, AEIS at 62.53 from our cost basis of 56.80. We're up 10%, $5.70. At that time, I could have opened a July 65 put at 520. Why the July put? Well, this not only gives me the advantage. Those of you who are buying calls know that when you buy a call option, if you buy it 2, 3, or 4 months out in time, you're not spending 4 times the cost of the near-term options, the 1 month out, the 2 week out, for example. When we sell premium, we want to sell week by week or month by month to get a better annualized return. When you're buying options for speculation or for insurance or for hedging, the opposite applies. We likely want to buy further out in time. The cost basis up front is more, but the cost per day and the annualized cost is lower. Why would I choose the 65 put? Well, I'm paying 520 for the position. That's pretty much 90% of the unrealized gain of 570 I have in the stock already. But the stock's at 62.53. If I'm purchasing a 65 put, $2.50 of this 520 is intrinsic value. I'm guaranteed to get that back. But in fact, remember the cost basis on our stock originally was 56.80. So with a cost basis of 56.80 here, and I add in another 520 on the position, my total invested now is $62. What does this put give me? We're at February, I'm buying a July put, so I'm essentially adding 5 months of a guaranteed exit at 65. What does that mean? The put gives me the right to force someone to buy my shares of stock at 65 no matter what happens next. Those of you who sell a call, of course, you know when you sell that call in a covered call position or a buy right or after you have a gain in the stock, you've entered in an obligation to sell your shares of stock if it's trading above it without doing any management. By buying the put, we've entered a contract that gives us the right. No one can force us to do anything. There's no assignment here. We're in complete control of what we want to do with this option. And for 7 months of time, we have a guaranteed exit at 65. We can force someone to buy our shares of stock at $65 at any time. But our cost basis is only $62 with the put and including our original cost basis. So now I have a guaranteed minimum profit. The worst case scenario, no matter what the stock does next, is I'm still guaranteed to make $3 or 4.8%. On February 17th, when that stop was hit, guess what? I'm not out of the position now. 2 days later, after I bought that put option and the stock was at 60.84 or below 61.50, I still control this option. No one can force me to do anything. I can get out of it at 65. True, only guarantee myself maybe a $3 return, but that's in the worst case scenario. If I bought this put at 520 on February 15th, and on February 17th the stock dropped down to, let's say, $61 per share or even $61.50, this time value is still going to hold in the position. It's a July put. That's not going to go to zero. And I'd probably gain another $1 or so because the stock dropped $1, maybe only 50 cents. So I could sell to close this put and maybe 580 or 590 and sell to close my stock at 61.50, and I'd still have a better stop than the $3 or the 8.3% that we locked in on the position with a trailing stop. Okay, so what are we doing here? Well, we're using an option instead of to generate income up front to protect the loss. Now, what do we mean by guaranteed exit? Remember, cost basis of 56.80 on the stock, I'm paying out 520 for that July put, 5 months away of guaranteed protection, but the put didn't go to zero. So that means even if AEIS opened the next day at $40 per share, $30 per share or lower, I can force someone to buy my shares of stock at 65, and I'm guaranteed to make 4.8%. And I control that. I don't have to exercise it. And in fact, if the stock dropped down to $40 in a 20-day period for whatever unknown reason, that put is still going to have 4 months, 3.5 months of time value plus the intrinsic value. I'd probably sell to close the put and sell to close the stock, and I'd do much better than this 4.8%. But this is now a locked-in gain. And the upside is still open. I didn't cap my upside by selling a call or doing another option position or increase risk by selling an out-of-the-money put, which I may have to put more leverage up to do. So here now we've satisfied number one, and it's guaranteed, as I mentioned. Unlike a stop order, if the stock gapped down to $50 overnight after I entered this trade, well, your stop order would have been triggered. You would have gotten out of the position at $50 per share, what the market's offering, not at 61.50 where you set your stop, because your stop was violated. Here I paid to have the right to close my shares of stock at $65 at any time. Okay, so that satisfies number one. What about goal number two? What about income? Well, earlier we saw we could sell the 60 call for $360 after it had moved up, our cost basis of $56.80. But here with the stock at $62.53, I could choose to sell to open the March 65 call now that I've locked in the gains, guaranteed a profit of $3 on the position, and I could have sold on February 15th the March 65 call for 90 cents. Now remember, we increased our cost basis by buying the put. Now we're going to reduce it, so the stock at $56.80 plus our put at $520 minus the 90 premium puts a cost basis at $61.10. Now, just like a covered call here, this would sort of cap my gain. I've got sort of a synthetic calendar going on. We'll look at the profit and loss chart in a minute, but my maximum profit is just the same as the covered call, even with purchasing the put. Max profit at $65 on March expiration would be about $783 or 12.8%. But now my guaranteed minimum profit, minimum, worst case scenario, the worst that could happen in this position is I'd still make $390 or 6.4%. However, I've got a small problem here. I've now locked in gains for goal number one. I've generated income to reduce my cost basis for goal number two, but my upside now is not open. Here's the profit and loss chart of that synthetic sort of calendar spread where we own stock at $56.80. We bought the July 65 put for $520, and I sold a March 65 call for 90 cents. So at March expiration, if the stock's trading right at 65, my profit would be $783 or 12.8%. Okay, and this kind of walked right into where I was going here, or point that I was going to make in a moment. Tom just commented in and said, okay, well, I don't see how you're getting $783. You have a cost basis of $61.10. Remember, that was stock plus put, $56.80 plus the $520 for the put minus the call. So my total cost into the position now, out of pocket, after the gain, is $61.10. If the stock's at 65, I'd be assigned at 65, so my maximum profit is only going to be $390. Where are we getting $783? Because I own a July put. And at March 17th, we still have 4 months of time value. Even though that July put is at the money, it's still going to be worth probably close to $4. I paid $5.20 for it when the stock was at $62.53. It moves up another 2 points to 65 at March expiration. Guess what? That put doesn't go to zero. Okay, that put still has 4 months of time value, so I could sell to close the July 65 put for $4 on March expiration, get the $3.90 profit to be assigned at 65 plus this. There's your $7.90, $7.85, $7.83 as well. Frank asks, will you hedge a stock as soon as you buy it? Yes, I would. We'll get to that in just a moment. Okay, we're going to talk about that in just a moment. All right. So here we have 2 of our 3 goals satisfied. We locked in gains. We generated income. We're equal to the return that we would have by selling the call originally. But remember, if I just sold the call, that 60 strike call for 360, well, both positions don't give us unlimited upside, but that covered call still has the risk to the downside. We're here, no matter what happens. Stock could drop to $10 per share. I can get out at 65 and have a guaranteed return of 390. All right, so 2 out of 3, not bad. But let's complete the hat trick. Locked in gains, generated income. But how do we leave the upside open? How can I possibly counter the obligation to deliver shares of stock at 65? Other than paying another $5,000, or in this case, almost $6,800. I'm sorry, $6,250, $6,250 on February 15th. What can I do that would increase in price or give me upside if the stock just continued to move up? Well, how about buying a March 70 call at 25 cents? I sold a March 65 for 90. If I buy a March 70 call for 25, I'm going to add back into the cost basis, so it's going to be $61.35. But remember, I'm still guaranteed to exit at $65. But if the stock rises, is our upside still open? Well, yes, it is. Okay, we've given our position here a little bit of a heartbeat. So, adding back in the call, we bought a March 70 call here for 25, and we've sold the 65 call here at 90. Now think about that just by itself. If stock is trading, let's call it 62.53, and I sell a 65 call for 90 and buy a 70 call for 25, this is a bear call spread, isn't it? Just the action of the 2 March calls would create a bear call spread. We'd receive a credit of 65 cents for a 5-point spread, which really would be a risk of $4.35. Sold one at 65, covered call, but now we bought an extra one. We did a bear call. Why would I do a bearish spread on a stock that I think might have further upside and I want to lock in the gains? What is the risk of a bear call spread? Well, if the stock moves up, I'm obligated to deliver shares of stock I don't own at 65, but I've purchased the right to sell them at 70. So if the stock goes up to 73, well, I got to close this position out. I sort of buy shares of stock at 70 to sell them at 65. I take a 5-point loss, but I keep that 65-cent credit, so I have a loss of $4.35. But when you own the stock, the obligation of this margin requirement, this 5-point margin, is canceled because you already own the stock. You just did a covered call and bought a long call. Your broker won't really see that as a bear call spread. You don't have to cover the margin, but if you're uncertain and the stock continues up, sure, you have an obligation to do something here at 65, but you own the stock to cover it, and you own a 70 call that will continue to gain. Or you could look at it as the 70 call will cover the 65 and the stock can still continue to rise unimpeded. Okay, so this little solution, buying an extra call at a higher strike after you sold the call, gives us a point where the position as a whole still has an unlimited upside profit potential. And we've already locked in the gain. We still generate a net credit. Yes, there's a little give up here, because if the stock moved up to 70, what would happen? Well, I have to cover this 5-point difference between the two strikes, but the loss that I'd have there is countered by the gain in the stock, because I still own the stock. It would have moved from 62.53 up to 70 as well. So that gain in the underlying covers the loss between the strikes, and you still keep the 65 cents. So the max profit, just as we saw, if we had just sold the call itself with a profit of about 785, we took some of that away by buying the higher strike call for 25. So we still have a profit of 760 if the stock's at 65 at March expiration. We'd still have a profit of 573, more than using the stop order at the time. And in this case, we could still be in the stock position. But remember, no matter what happens, we still have that guaranteed profit. The stock could fall to $30 and we'd still be guaranteed to make about $385, $395 as well. Joe, he says, wouldn't your put lose value as the stock goes up? Yes, but this stock chart is showing that. This profit and loss chart you're seeing, Joe, is the entire combination of where we were before. Oh, sorry, let me clear this up, Joe. Where we were before, when we had the put and we sold the call, this is all three of those transactions: stock, long put, short call. So yeah, why does this curve away if we had just sold the call? It's because we've capped our gain on the stock at 65. And if the stock continued to move up, the put would lose value and we don't get any more positive delta on the stock. In this situation here, Joe, what we're looking at in this case, this includes the put. So what happens if the stock's at 75 at March expiration? We're showing a profit here about $900, maybe a little bit more. Let's call it $950. How is that possible? Okay, stock's at 75. Just as the components alone, Joe, we have a stock at 56.80, now trading at 75. I sold that call for 90, which would now be worth $10 to buy it back. So let me put 0.90, and let's say just intrinsic on our 65 call at 75 cost me $10 to buy it back. The 70 call that I paid 25 cents for would now be priced at $5. So there's my $5 loss, but we took in the 65 cents. But it's a July 65 put. It didn't go to zero. Oh, sorry, folks. My apologies. Let me go back one. There we go. July 65 put that I paid $5.20 for. I still have 4.5 months of time remaining. It's out of the money, but it doesn't go to zero, so this might still be worth about $2. Okay, so what do I have? I have a loss of $4.35 on the call transactions. I have to close this out for a 5-point loss, but we keep the 65 cents. The stock we originally got at 56.80 has moved up to 75. All right, so it's about an $8.20 gain. Okay. Wait, I'm sorry, I did that completely wrong. My apologies. Sorry about that, Joe. So we've got about $18.20 gain on the stock. Now I'm factoring in the calls here, so we would have a loss of $4.35 on the call, gain of $18.20 on the stock with it trading at 75, and a loss of $3 there as well. So we lose $7.55, but we gain $18.20. The put loss would be factored into there. That puts us around the $1,000. So maybe this is only worth $1. The put would only be worth $1. It went down, but the gain in the stock more than countered it. It's still a positive delta position with the stock plus the put if set up correctly. There are ways to do this incorrectly, but we'll talk about that as well. All right, so to answer your question, Joe, remember how we looked forward. And we did this on February 15th when the stock had gained 10% and was trading at 62.50. What happens to our hat trick position now that the stock's trading up at 68.62? Not the 75 I just showed because the put's still losing value, but it's losing value in both situations. So here's what happens. Your cost basis on the stock was $56.80. So we've got that unrealized $11.82 gain in the stock on March 17th. Same as we did if we hoped and did nothing. What would it cost me to close the call? Well, about $3.70. Okay, intrinsic value plus some commissions. Remember, we took in the 90 cents for it. We'd have to pay $3.70 if we wanted to close it. Our March 70 call, well, the stock really didn't gap up as we expected, but we lost the 25 cents. That July put that we paid $5.20 for when the stock was trading at 62.53 is now still priced on March 17th at $3.35. It's out of the money, but this is all time value on the position. Okay, I still have 4 months of time value remaining, so it's priced at $3.35. So what do we liquidate? We sell to close our stock at 68.62. It's $11.82 gain, but I got to pay $3.70 to close the call, and I could sell to close the put at $3.35. So we lost $1.65 on the put. But the stock moved from 62.53 to 68.62. It's another gain of $6.10 on the stock, and I only gave up $1.65 on the put. The total liquidation value is 68.27, right? Because we paid $3.70 to buy to close the call. The other call goes worthless. Sell to close the put at $3.35. So essentially, I'm paying 35 cents to close this call. So that reduces from the current stocks to 68.27. So our liquidation gain, remember the 61.35 here includes stock, the put to lock in the gains, and the credit from the two calls. So we had a 61.35 cost basis after this adjustment on February 15th. Our liquidation value would be 68.27, so we have a gain of 692 or 11.3% on the position. Okay, so some of you are probably already asking this and you're already thinking this, why do all that work? How does this stack up? Remember, if you'd closed the position on February 15th, gain of 570 or 10%. You closed half and left the other half open. On March 17th, you would have had a gain of 876 total or 15.4%. If you would have sold the March 60 call on February 15th, generated $360 of premium but got assigned, maybe you didn't want to put in the $9 to buy to close the call and adjust it, you make $680 or 12.8%. Remember, if you set a trailing stop, you got closed out 2 days later. We got a gain of 470 because we set our stop at 61.50, so we make 8.3%. Those of you who did nothing, you've got a gain of 1182 or 20.8%, but now you have to start the cycle over. What do you do next? Because you were lucky. You were hoping and praying, and your hopes and prayers were answered. It moved up another $6, another 10% after the first 10% move, essentially. Now you're looking at a 20.8% gain. The hat trick, which solved all three of our goals, still outperforms the trailing stop, outperforms closing early, but falls to the other three examples. Okay? Well, but remember, this is March 17th. I'm holding a July put. I still have 3+ months of protection and guaranteed exit at 65 in place. So those of you who commented earlier, well, you could just roll that 60 call with the stock at 68.62. Well, you're going to pay $9 and roll up to a 70 strike. Remember, our put was still worth $3.35. I could have sold that July 65 put for 335 and rolled up to a July 70 put and probably paid about 550, maybe a little higher. Let's call it 6. Okay, so what does that mean? It means I'm paying a debit of 270. The cost of my 520 put was already factored in. I sell to close it at 335, which we saw. I buy to open the other put at $6. So it cost me 265, but I'm guaranteeing a 5-point higher exit. I moved the put from the 65 to the 70, still 4 months out. So I add $2.65, let's say, to my cost basis, but I'm guaranteed to get 5 points higher back. That would have moved that guaranteed profit from about 390 up to about 620, guaranteed. And if the stock continued to move up, I could still realize further upside gains as well. So again, the hat trick beat the return of closing for the gain and using the stop loss. We guaranteed and locked in our gains first. Then we looked at selling the call to satisfy the second goal of income generation and applied that extra call, essentially a bear call spread, to leave the upside open. Now the hat trick didn't beat just selling the 60 call. It did not beat just closing half or doing nothing. But what is the one thing I did with the hat trick that did not exist with any other adjustment? I had a guaranteed return that I controlled. The stop order does not guarantee you a return. It does not guarantee you a profit. It only guarantees you a profit if your stop is hit during the trading day. Any unexpected events that happen in the pre or after market hours, your stop loss can be violated. You get filled at a lower price, not the price you hope for with the stop. So is that really relevant? No. Let's talk about it. On about the same time, we got into AEIS on January 27th. UBNT was trading at 61.75, Ubiquity Networks. Again, 12, 15, 20 days later, stock's up about 4%. Okay, so on February 9th, the stock moves up to about 64.13. Now that's a high. I'm not saying I could sell it right at the close at 64.13. It was actually higher intraday. I think it was as high as 64.80, 64.70 on February 9th. Okay, but in that short period, 12 days or so, 12, 15 days, the stock is up 4% from our purchase price. Again, what could we do? We could sell to close now, take the gain. We could close half of our holdings, lower our cost basis down on the position, and still leave half open. I could have sold a 65 call for maybe 80 cents or $1. I could have put a trailing stop at, let's say, 63 to still lock in some of that unrealized gain from 61.75 to 64, maybe even 63.50. Close, but let's just say 63.50, for example. Or I could have done nothing and left it alone. Similar price stock, similar fundamentals and technicals. Of course, not as much gain as we saw in AEIS, but we've got a 4% gain in about a 12-day period, 15-day period. Okay, so what happens next? February 10th, stock falls in the pre-market down to 53. And the next day we're trading at about 51. And a few days later, we're trading at 49. Okay, so if you would have closed, you would have taken a 4% gain. If you set your stop order at 63, and the stock fell here to 53, guess what? It was in the aftermarket hours. You don't get filled at 63, you get filled at 53 for roughly a $9 loss, or just about an $8 loss from your purchase price of 61.75. Not 64.13, remember, we would have only paid 61.75. Stop order wouldn't have helped you. What if you sold that 65 call for 80 cents? Well, you'd reduce your cost basis down to 60, but now your stock's at 53. Okay, so we call this sort of the tale of two stocks. We saw the outcomes on AEIS, but on UBNT with a similar situation, if you closed, you would have taken a 4% gain. So if you had AEIS and you had UBNT and you followed that rule for closing. Okay, you might have been looking for a 10% gain, but let's say you made a 10% gain on UBNT. I'm sorry, 10% gain on AIS and a 4% gain here on UBNT, you'd be up 14%. Didn't take advantage of the further upside. What if you had closed half of UBNT, reduced the cost basis, and then the stock fell to 53? Well, you'd still be at a loss. So you would have made 15.4%. Remember, it was about 876. But even if you reduced your cost by selling half when the stock was up 4%, you would have still had a loss. Remember, this was a gain of 876. You would have still been at a loss of about $700. Because you would have cut your cost basis down to about 59 from 61.75, but now the stock's trading at 53 and then moved lower, so you're only looking at a gain of 176. Selling a call, you've got a loss of $9. And remember, on AEIS, you didn't make that much. You made 12.8%, but the loss here of 9 points from, let's say, 60.75 down to 53, well, it's only about 7 points. So you didn't really make that up on the covered call, or just barely broke even. A trailing stop, well, you did make 8.3% or 470 on AEIS when you got stopped out, but here, setting that stop at about 63, when the stock was trading at 64, well, you got filled at 53. So you're still looking about close to that $9 loss as well. So instead of making 470, you're down 430. Doing nothing. Well, you might have been ahead because you got lucky and had an extra 10% gain. So you had a $11.28 gain here, or 20.8% on AEIS. Now you're looking at a loss at about $9, getting closed out at about 53 if you closed it at 53, but then later closed it at 49. It's almost $11 loss. You wiped out the first gain you had of 11.28 or 20% by having the stock at 61.75, and now it's trading at 49.50 or even 49.75. Okay, so you've wiped out that loss by doing nothing. And the hat trick? Well, remember at March 17th liquidation, we had less of a gain. Okay, but at the same time, if the stock had moved up from 61.75 to that $64 per share, up 4%, with the proper structure, the hack trick could have guaranteed me about a 1.8% guaranteed return. I'm sorry, I did that wrong. Guaranteed return to the downside with unlimited upside. So we would have made about 1.8% even with the stock trading at $53 per share. So that's a positive gain of 1.8%. And you saw what we already had on the existing position as well. Okay, so that's the tale of two stocks. What did we talk about? How not only do we hate having a gain and watching it become a loss, but we hate seeing a 20.8% gain if we followed through and did nothing and watched UBNT move up from 56.80 up to 68. Right? It was a gain of about 11.28. Was it? Yeah, 11.80 or so on the position. To if I had done the same thing on UBNT, just a few days after opening, 20 days after opening the position, the stock would have gone from my purchase price of $61.75 to about $50 per share. There's that $11 counter. Right, 50% of the time I had a 20.8% gain on one, but the loss on the other essentially wiped it out completely. Okay, so what I showed you today is what is possible. It's actionable in what you can do in your account right now. If you have a gain in your underlying stock, or the next time you have a gain in your underlying stock, you can satisfy all three goals by looking at it a different way. Rather than focusing on selling the call or doing nothing or closing out of it, maybe look at putting a little more money into the position to lock in the gain that you control. Sure, stop orders are free, but stop orders are fickle. You still would have been closed out for $9, $10 loss on UBNT after the 4% gain on the position, setting a stop at around 63 or so. You only get that if it happens intraday. An unexpected event happens or a surprise earnings and the stock drops 12, 15, 20%. Overnight, you get filled at the worst possible price. So of course trailing stops are free, but you get what you pay for. I'd rather pay a little bit of money to lock in some of the gain on the position and have that guaranteed to me that I control. When I buy the put, no one can take it away from me. I can't get assigned. I control if I want to exercise it or sell to close the position. So I have a locked-in gain that I control. I still have the ability to generate income against the position, to lower my cost basis, and with another simple little tweak into that, adding that extra call, I leave the upside open. I satisfy the 3 goals I want when facing a gain, and that is the hat trick for locking in gains and going forward as well. Now, if you have a stock that is up in price, you can go onto your Power Options account, or if you don't have one right now, remember you can go to powerop.com at any time and just put in your name and email address, and you can start a 14-day free trial, no credit card required. But once you log on to Power Options, even if you just start your trial today, there's something called the insurance tool under the Married Put tool, and also in what we call our signature tools section. And it's a simple tool where you can put in your stock symbol and your cost basis. And this tool will show you which puts you can buy to lock in most of your unrealized gain and still leave the upside open. And there's other tools you can use to see how you can complete the hat trick by generating income but still leaving your upside open. Someone asked, well, with that bear call spread, I'm not allowed to trade spreads in my IRA, so I couldn't do this. Yes, you can. If you're at this webinar, it's because you're trading options. And if you're in a restricted account and you have level 1 trading in most accounts, some can start at level 2. But even in the most restricted IRAs, if you apply to trade options, you'll be allowed to sell covered calls, buy calls, and buy puts. So that transaction where you have a gain on the stock, you buy the put, you're allowed to do that. You're insuring the stock, though, not speculating on a movement on an index or an ETF. You're insuring your position by buying that put. Well, now you sell the call. That's allowed. You own the stock, you protected it with a put. Broker doesn't see it that way. They just see that you own a stock, you own a put. Well, now you're selling a call against the stock that you own. So it's a covered call. That's allowed in your restricted account. And then you buy a call. Well, you're allowed to do that too, but you now have all 4 legs in place. It's not a bear call spread. It's essentially a covered call with an extra long call, and you insured the whole kit and caboodle by buying the put option. So yes, if you're allowed to trade options in a restricted account and you have what some call level 1 or level 2, you'll be able to do this transaction without any issues. Okay, so some other questions came in a while ago. We answered Joe's about doing that. Frank asked, would you hedge a stock as soon as you buy it? Well, yeah, I would. And that's what we do here at Radioactive Trading. And I want to show you something real quick here. I'm just going to log on to my account here at radioactivetrading.com. Okay, and AIS, there we go. Oh, I'm sorry, there we go. Okay, let me move over here. Let me show my screen here. Just so you know that I'm not fibbing. At radioactivetrading.com, we do offer a subscription service called Fusion, which further enhances the ideas in the blueprint, and I'll talk about that in a moment. But Frank, to answer your question, this is the position that I sent out to my investors, the Fusion subscribers, as you can see in July 23rd. This is an actual position in my actual account. I opened the position initially. I'm sorry about that, folks. Let me make sure you're looking at the right screen. My apologies. Yep, there you are. Might be a little bit hard to see, but the position was a real trade. We bought AIS at 56.80, and at the time I bought that 60 put for 7.30. Okay, so initially I had a potential for a loss on the position. My total investment was 64.10. I was guaranteed to get 60 back, so I opened the position with a guaranteed worst case scenario of only a loss of 6.4%. I did the same thing on UBNT, by the way, where I bought the stock at 61.75 and bought a 65 put, which guaranteed I couldn't lose more than 5.5–6% on the position. which we all saw it drop 20% later on, but I could still get out of the position for only about a 4% loss. Okay, now we talked about management of the position that you could do. Sorry folks, there we go. Now sure, I did sell a call at one point. I rolled the call, but look here. Might not be easy to see, but back on March 9th, close to where we were talking about, AEIS was up to 63.10. You know, not at the time it was at 62.50, but later on it was at 63.10. Remember, I bought, oh, here it is, I'm sorry. We had purchased that July 60 put. I'm sorry, just looking at something wrong there. For 760, I'm sorry. But as the stock moved from 56.80 to 63.10 on the position, all right, so it moved up from 56.80 up to 63.10. That's a $6.30 gain on the stock. The put on AEIS that I had purchased was still worth $3.23. So I only gave up a little under $4 for that position. So it was still a positive delta gain, but we rolled up to the 65 for $5.56. So what does that mean? It means I paid a debit of $2.35 from the starting point, but I'm getting a 5-point higher payout on the position, which as you can see took my risk down to only 1.5%. Almost what we call bulletproof, where we saw there in the beginning, if you have the unrealized gain in the stock, you could buy it then. I start it this way because I control the risk from the onset, where yeah, if I'm right and the stock moves up, I give a little bit back on the put, but as Joe mentioned earlier, it's going to lose, but I'm still at positive delta on the position. So as the stock moves up, I lose less on the put. Okay, all right. Let's go back here to where we wanted to go. So that's how we approach things here at Radioactive Trading. Now, Mike asked a question a while ago, what income method are you talking about? What does he mean by income method? This is Mike D who asked this question. Well, here at Radioactive Trading, what I just showed you is the position I opened with the put in place at the beginning to control my risk and guarantee I can't lose more than single digits. That's how we open every position at Radioactive Trading, the stock plus put combination, following the rules described here in the blueprint. What we discussed today, there's a full chapter in the blueprint on bulletproof from the beginning. How to look for the best insurance if you have a gain on the stock. That's just one chapter of the 15 or 16 or so that are contained within the blueprint. The blueprint also contains how to set up that structure from the beginning, as we just showed for Frank, as we just showed there as well, so that we have a controlled limited risk up front, but we can still apply the adjustments afterwards to cancel all of the risk, have a guaranteed profit to the downside, and still be able to generate income and leave the upside open. Mike, what we showed with selling the call, doing the bear call spread, that's income method number 6 in the blueprint. It's the bear call spread which allows us to generate income and leave the upside open. Whether you had it as a married put before or you added the put later to complete the radioactive trade after you had an unrealized gain to lock in some of that profit, but even from the start, we could have used income method number 6 against the protected put position. That's what is contained in our product, the blueprint. It discusses how to open these positions with limited risk, controlled risk, where you have insurance out 6 to 8 months out in time or more, but you can't lose more than 6 to 8% on the position. How to manipulate those positions using what we call 12 different income methods. Adjustments we can make on those positions. We showed you income method number 6 today. Why 12 income methods? Well, some are used if your stock moves up from when you originally purchased the stock and put position to have a properly structured trade. Some of the income methods work best if the stock stagnates. It didn't match your expectations and it's just sort of going up plus or minus 0.5% over a 20-day period. There's still adjustments you could do to lower the risk and generate income. And even if the stock falls, it's a bullish position, but even if the stock falls from when you open it, there are income methods you can use to reduce the cost basis, reposition the structure of the trade, or even profit on the downside if the stock continues to fall against you. Now you can see more about the full blueprint, how to apply this to your account, and of course the full chapter on bulletproof in the beginning. You can read more information there at that link I have here, radioactivetrading.com/iridium, IRIDIUM. I'm going to send that to everyone in the chat window right now. Okay, so radioactivetrading.com/iridium. There you'll be able to see more information about the blueprint and how it can help your portfolio. Not even just after you have a gain, but from the onset. Let me tell you how happy I was I opened this radioactive trade on UBNT, and even though it moved up 4%, I was able to take advantage of that. Well, it dropped 20, 15% a few days later. I'm not going to lose more than 4% on that position. I'm still trading it because there are adjustments I made to keep going with the position and potentially guarantee profits going forward as well. All right, so you can check more on the information there at radioactivetrading.com/iridium, and you'll also see on that page the 5 special bonus offers, free bonus offers that we have running right now if you decide to pick up the blueprints in the next couple of days. All right, well, ladies and gentlemen, that's what I wanted to share with you today. Something you can use right now if you're sitting on an unrealized gain on a stock or even maybe a long call position. I'll admit freely that what I showed you on AEIS, the hat trick performance of buying that July 65 put, performing that income method number 6, the bear call spread, didn't outperform selling half of the stock and leaving half open. Wouldn't have outperformed just doing perhaps the covered call. And of course it didn't outperform holding and hoping and doing nothing because the stock moved up another 10% and you would have had a 20.8% gain. But remember the tale of 2 stocks. Not every stock is going to continue up. And if you did 2 trades at the same time as I showed, if you did AEIS and UBNT, on AEIS using the hat trick technique, you still would have locked in an 11.3% gain on your cost basis if you liquidated on March 17th. And on February 10th and 11th and 12th, when UBNT was down 20% at about $49 per share, applying the hat trick on, I'm sorry, it wasn't February 9th, but applying, yeah, it was February 9th, applying the hat trick when the stock moved from 61.75 on January 27th to 64, you could have locked in a 1.8% gain. So you would have made about 13% total on both positions, maybe equal to closing out. But remember, if you would have chosen to close out for just a 4% gain, if you didn't look for the 10% gain, if you didn't close it out with that 4% gain in the first 10 days or so, you'd still be at a loss right now. That structure could profit on both positions, even though one moved up 20% and one dropped down 20%, by applying this hat trick that we call for locking in gains. All right? Well, I hope you enjoyed today's presentation. I hope you got some useful information of adjustments you may not be using in your account, but you can potentially use in your account. Remember, the full story and all 12 adjustments is available in the blueprint. Check out that link, radioactivetrading.com/iridium, to see more about the blueprint, the radioactive trading techniques, the special bonus offers we have right now. And don't forget, if you have a stock that's up, you could right now, another free session for you, another free item. Go to powerop.com. You just have to put in your name and email address to start a 14-day free trial. Under the Married Put tab, in the signature tools, you can click on the insurance tool, put in your stock symbol, your cost basis, see which puts you could buy to lock in profit right now, and then scroll through some of the other tools to see how you could complete the hat trick once you've locked in the gain first. But of course, if you have any questions later on, please feel free to send me an email to support@radioactivetrading.com. Remember, you can also call us during market hours at 302-992-7971. And if you live in the U.S., you can reach us at 877-992-7971 toll free as well. Ladies and gentlemen, thank you again for joining me today. We did